Welcome to the Explainer. Let's get right into it. We're diving into some incredibly powerful data today from the GoDubai Global Property Radar. Specifically, we'll be using their global ROI calculator at godubai.estate/global-ROI-calculator to figure out exactly how international real estate investing is being completely transformed for 2026. Let's dive in. But before we get totally lost in the data, we've got to ask ourselves a pretty crucial question. Where exactly is our capital going to work the absolute hardest this year? You already know the landscape is shifting daily. New regulations, emerging markets, changing tax laws. Relying on yesterday's playbook? Yeah, that just won't cut it anymore. So, to break this all down, we're going to move through 6 key areas today. The global property radar itself, core powerhouse markets, European golden visa hubs, high-yield tropical markets, cross-border trends, and finally, how to choose your exact strategy. First up, Section 1, the Global Property Radar. This is basically the ultimate 15-country real estate and investment analyzer. Moving right into Section 2, core powerhouse markets. We're talking the true heavyweights here, the UAE and Saudi Arabia. So if you're the kind of investor who likes massive scale and rock-solid stability, let's call you the core market traditionalist, Dubai's consistency is just staggering right now. Take Jumeirah Village Circle. We are seeing average gross ROIs between 7.5% and 9% for long-term yields on mid-market apartments. And over in Dubai Marina, it's pulling in 6.5% to 8.2%, which is heavily driven by short-term Airbnb rentals in those waterfront high-rises. It's a market that gives you distinct, highly reliable strategies depending entirely on the asset class you decide to go after. Now, hop across the border to Saudi Arabia, and the numbers are just as wild. The King Abdullah Financial District in Riyadh is hitting 8 to 10%, primarily through high-demand corporate leasing. But check out Mecca. Central hospitality units there are projecting a massive 8 to 12% return. And that is based almost entirely on seasonal pilgrimage demand. It's a completely different asset strategy, but man, is it lucrative. All right, let's pivot. Section 3, European golden visa hubs, passports, and those gorgeous Mediterranean markets. Enter our second investor persona, the passport seeker. If this is you, cash flow isn't your only goal. You prioritize relocation and EU access. And the crucial data point you absolutely have to know is this massive threshold, 800,000 euros. Greece literally just raised its golden visa minimum in prime areas, think the Athens Riviera, Mykonos, Santorini, to this exact mark. Meanwhile, Spain is heavily debating changing its own real estate visa. This is sending absolute shockwaves through global investor behavior. Because of these shifting laws and skyrocketing thresholds in Spain and Greece, capital is predictably flowing right to the path of least resistance. We are seeing a massive surge of interest towards Cyprus and Malta. South Cyprus is offering 5.5% to 8% yields alongside a really strong path to permanent residency and corporate relocation. Malta is heading 5 to 7.5%, which is heavily propped up by its massive iGaming expat community. Okay, Section 4, high-yield tropical markets and the Tropic Chaser strategy. For the high-yield tropic chaser who just wants raw cash flow, the tropics honestly look completely unbeatable on paper. When we compare maximum gross ROIs on a global scale, Bali's potential 14% yield clearly leads the pack. North Cyprus follows up incredibly strongly at 12% for beachfront property. Both of these easily clear the UAE's ceiling of around 9%. Looking a little deeper into Southeast Asia, spots like Phuket and Thailand and Canggu and Bali have become absolute havens for digital nomads. Thailand is pushing 7 to 10% returns through condotels and retiree visas. Meanwhile, Indonesia is hitting 9 to 14% for villa cash-on-cash returns. If your strategy is monetizing that laptop on the beach lifestyle, the gross revenue potential here is just astronomical. But time for a quick reality check. 14% sounds incredible, right? Well, your net return is going to stabilize quite a bit lower. In these tropical markets, you really have to account for local taxes and some pretty hefty short-term management fees. We're talking fees that can easily eat up 20 to 30% of your gross. Once you factor all that in, your net cash-on-cash return usually stabilizes around a very solid, but definitely more realistic 8 to 9%. Which brings us perfectly to Section 5, cross-border trends, taxes, and the true nuance of global investing. This right here is exactly where the amateurs get separated from the professionals. Search data from the radar shows that queries for off-plan yields in places like Batumi in Georgia or Dubai Creek are totally surging.
But when you're actually building your strategy, you've got to weigh the potential flipping margins of pre-launch projects against the internal rate of return you'd get from a ready asset with a post-handover payment plan. Capital appreciation during construction is fantastic, for sure, but it demands a totally different liquidity timeline than a ready-to-rent apartment. It's the exact same thing when comparing asset classes. A tropical Airbnb brings those high management fees and big seasonal swings, like summer highs in Greece versus winter highs in the UAE. On the flip side, AU long-term properties offer incredible, steady stability. But they also come with strict tenant protection laws that cap your ability to hike up the rent. It really boils down to a classic trade-off: high-maintenance cash flow versus low-maintenance capital preservation.
And listen, you simply cannot accurately calculate a commercial cap rate or a net ROI without factoring in hidden acquisition costs. We're talking things like Saudi Arabia's 5% real estate transaction tax or Dubai's 4% land department fees, navigating Oman's usufruct ownership structures, or figuring out Cyprus's VAT. This is exactly why plugging your numbers into a tool like GoDubai.estate/global ROI calculator is basically mandatory if you want to get your true localized net figure. Finally, Section 6, choosing more strategy from over 1,600 available intelligence reports. So now that we've mapped out the investor personas, the global yields, and those hidden pitfalls, how do you actually pinpoint your exact market? Well, the Radar portal offers over 1,600 intelligence reports. This means you can instantly scan the globe for exactly what you need. Whether you want a matrix for the absolute highest rental yields, the most liquid property markets for a safe exit, or just the best overall risk-reward ratio, it is all right there. And for those of you seeking a much more nuanced approach, the system goes even deeper. You can filter for hidden gems and undervalued sleeper markets to get in before the rest of the world catches on. Or, if you're looking further down the road, you can identify regions that are mathematically perfectly positioned for stable wealth preservation and reliable retirement income. We've covered some incredible ground today, but data without action is basically just trivia. The markets are shifting literally as we speak, and tomorrow's prime yields belong to those who calculate their moves today. Armed with the tools at GoDubai.estate/global-ROI calculator, the only question left to answer is this: based on your specific investor persona, where will you plant your capital before the rest of the world catches on? Thanks for joining this explainer, and happy investing.